Please welcome my colleague Ryan Clements, Director of Advanced Research and Knowledge Management at the ASC, to the stage. And Ryan, I will let you introduce your panel members. Okay? Thank you all.
Good morning, everyone. It's a pleasure to be with you. I'm Dr. Ryan Clements. I'm the Director of Advanced Research and Knowledge Management at the ASC. I'm also the chair of the CSA Financial Innovation Hub. Over the past year, artificial intelligence has been the subject of numerous media reports. A lot of people don't understand what it is, though, what that word even means, and how many technologies it captures. They're not sure how it's going to impact their lives and their industry. So we're pleased today to have an expert panel that are also expert communicators that can help us to understand exactly what this technology is, the opportunities that it will present for capital markets, and some of the challenges that it may present as well. And most importantly, what we as regulators should be thinking about in relation to artificial intelligence. So if you'll join me in welcoming to our panel Chad Langager, who is the CEO of AlphaLayer and a member of the ASC's Technology and Innovation Advisory Committee, Carole Piovesan, the co-founder and principal of INQ Consulting, and Dr. Martin Petrin, who's the Dancap Private Equity Chair in Corporate Governance at Western University. So I mentioned that artificial intelligence is a concept that can be really confusing to a lot of people. A lot of times when people think of artificial intelligence, they're thinking about perhaps generative AI, some ChatGPT, and asking questions and getting outputs. Some people might even be thinking of science fiction and this idea of artificial and super intelligence. We want to narrow our discussion today and focus it in on the capital markets, what the opportunities are, what the challenges and risks are, and what we should be thinking about as regulators. But I want to start with some audience engagement. Let's get a sense of what you think about artificial intelligence and its impact for financial markets. So if we can start the first audience engagement poll, please. So what I have here is we're going to do a word cloud exercise. So if you look at the QR code on your table, there's a poll section. I'm just asking a simple question, and we're going to start the panel building off this idea once we see some general feedback. So what are the important use cases for AI in financial markets? When you see words become larger, it means that multiple people are putting the same word in. So we're getting compliance, we're getting a variety of things, so this is great. Data collection, modeling, research optimization. So it's good. We're seeing some specific use cases come through. So I'm going to build off that by starting with our first question to our panelists. And I'm going to actually direct the same question to Chad. So in your view, what are the most important use cases of AI in financial markets? And particularly, what should we be encouraged about? What are the opportunities? Chad.
Yeah, perfect. I mean, it's always good to see AI still on the agenda. It's been going through quite a resurgence lately with large language models like ChatGPT. So it's a very, very exciting time. When we narrow it down, or we narrow our thinking into the financial market specifically, I think there's three key areas that really stand out to me and seeing a lot pop up here as well. I think the first one, which is obviously closest and dearest to my heart, is around the research function within capital markets. So leveraging artificial intelligence, leveraging machine learning, ChatGPT, large language models to understand financial markets. So this can be everything from building predictive analytics to building trading strategies that leverage artificial intelligence. So I'll give a couple of quick examples. So we've built some technology, or been on some cases where you want to explore as a fixed income team credit rating changes. Obviously credit rating changes to the negative are very bad for fixed income teams. So can we go out and actually predict using machine learning whether a company is likely to see their credit rating change to a negative? And yes, you can, as an example. Another example that I see here is around collecting data, seeing trends, putting together prospectuses, doing research optimization. This is another type of technology that you can use, like large language models. Think of that morning report that you send out in the morning to your team about what's been happening with the markets. You can take in all the data feeds related to the market and pre-populate a sort of first version of a morning note and then have a human go and finish it. I think a lot of people have started doing that with technologies like ChatGPT. So one of the benefits of this technology is in the research function. A big gain is delivering better risk-adjusted returns to your client, to doing research at a faster speed and scale, which is one huge important use case within the financial markets. A second one that I think will touch many more people within the financial markets as active participants is around automation. So there's a lot of automation happening with this technology where we look at a lot of the low-level tasks or tasks of little value. Can we go in and use this type of technology to automate it away so that we can move towards items of higher value within our process? There's a lot of specific cases in that as well, whether it's automating capital calls and distributions within the real estate side. There's great use cases around that as well. The big thing there, though, is within your day-to-day function, what are the things that are repetitive, monotonous, that don't add value to your organization that you can attack with this type of a technology and then free up your time to those higher value tasks? And then the last very broad one that sort of moves out of maybe the specific workers within the financial markets, but more to the clientele of the workers, is around customization. So a lot of the technology that's being developed right now with large language models is allowing us to scale how we interact with users or how users interact with financial markets. So you think of every single person in this room has a specific sort of financial plan and vision and goals, and it's going to vary from every single one. Now, you could have a financial advisor sitting with every single one of you, but the vast majority of people within the markets don't have financial advisors. So could you have a system that scales the benefits of financial market participation, financial literacy to more and more people? So I think there's going to be a huge boom in towards customization for individuals to increase financial market participation. And in terms of like what's exciting about this, I think with the advent of things like ChatGPT, where AI has moved in this latest boom away from this machine learning, what exactly is it, to something that's far more tangible for everyday individuals, is that we now have this lens on our individual jobs, on our businesses, that we're now looking and saying, what can actually be solved within my business? What can be taken away that's suboptimal so that I can really focus on value adds?
Excellent.
So just building off the excitement and actually touching on something that Peter said. So Canada, we need to assert ourselves. We need to step forward in terms of leadership. Tell us about Canada's role. Maybe I'll ask Carole this. Like, what is Canada's role in the international ecosystem for AI development? And what are the trends in terms of capital formation and investment in Canadian-based AI?
Yeah, so you just heard Chad give a number of really excellent use cases of how artificial intelligence can be used in the sector. And yet StatsCan came out with a report in September of this year suggesting that 72% of executives of Canadian businesses do not see relevant use cases for AI, which is a terrifying statistic given that the rest of the world sees artificial intelligence as a major productivity gain. And we can quibble as to the extent to which that is correct or not. But the point is, there is a technology that is facilitating our ability to do things faster, more accurately, with less human risk of human error. And yet, as businesses, we're not quite seeing that, and thus not using the technology to the same way. So our adoption rates are actually quite low. And yet Canada has a lot to boast about. If we go back to the earlier panel that we heard, that we need to sort of focus on what our strengths are, be clear about it, get behind it, and be proud of it. This is actually one of those sectors where we can do that. where Canadians, as in research and development and in innovation, we have stood the test of time through the AI winter and forward into innovating in the AI sector and leading to the point that it's out of Montreal, out of Alberta, and out of Edmonton, out of Montreal, and out of Toronto, we have had the 3 most advanced AI centers recognized in by some of the highest awards, including the Nobel for Physics. So we were the first country to come out with the national strategy on AI in 2017. We have been aggressive in speaking about the ethics and responsibility of AI. That is actually a Canadian brand, and yet we don't adopt our own AI. ChatGPT is an excellent use case. We actually have Cohere, that is a large language model that is also using the same types of technologies, and it is made in Canada. So just to say that there are wonderful use cases, and to play off the theme of the earlier panel, this is actually an area that we can and should get behind as Canadians.
Excellent. Thanks, Carole. Okay, so let's go to the second engagement question, if we can. Actually, audience engagement question. Thank you both for explaining the opportunities, the excitement, the encouragement, Canadians' leadership position. Let's shift gears a little bit. So what are the most significant risks? I'm asking the audience, what do you think are the most significant risks in deploying AI systems in financial markets? So let's see what the audience has to say, and then we'll build off this thing. So we're seeing security, privacy, bias.
Security,
Very good.
privacy,
Confidentiality,
bias.
fraud,
Very good. Confidentiality.
hallucinations. We should probably define that in a digital context.
Well, actually, I'll jump in quickly. Hallucinations is basically like this idea that when you ask a model something, it's forced to return you an answer. If it doesn't actually know, it's just going to give you something, and that's what's considered a hallucination. It's also called BS.
Yes.
Data in, result out. We got to think about, we're going to get to that. We're going to get to that data in piece in a second here. So we've got a variety, so we've got a learned audience. This is great. I'm going to now pose this to Martin. So let's build off this, Martin. So in your view, what are the most significant risks? But what I'm most interested in from you is what concerns you most as a scholar and an expert, particularly in governance?
Yeah, sure. So I think I agree with many of the things here on the screen. So I would highlight just a few. Of course, there are a range of possible risks, but let's start with bias and errors. So bias is, of course, just a reflection of AI being only as good as the data that it's being fed. So if the data is biased, that means the outcomes are biased or can be biased. A classic example is discrimination in credit scoring. And then we can also have inaccurate data, which means there will be poor predictions in financial markets. That might mean asset mispricing or flawed trading strategies. Then we can have design or operational errors, and that in conjunction with some other errors might lead then to those dreaded hallucinations that the audience mentions here. So, misleading or incorrect results. And, I see it all the time in my line of work, right? Like corporate law and governance. The AI says, there's the milestone case of, whatever against whatever. I'm like, oh my God, I didn't know that. I have to look it up. It doesn't exist. And so if you can imagine that in the capital markets, the AI makes up in, say, sentiment analysis, a statement by a CEO that doesn't exist, or misinterprets a geopolitical event, it can be quite catastrophic. And then we can also have errors despite having perfect data, because the data is not kept up to date. So that's called model drift or model decay. So that's also a risk. And then something that I don't think I see it, but is a concern that is often mentioned is explainability. We often say that AI is a black box. There's millions or billions of parameters, and we don't really know what's going on. We don't know, why did the AI say that certain transaction is a fraud? Or why did it decide that the investor should have a certain allocation, a trading strategy? We don't really understand anymore what's going on. And with the use of third-party AI, that's becoming even worse because we don't know what these third parties are using in their models. But I think so it's a concern, but we should also mention that we don't have to understand everything necessarily. So some explainability, is helpful, but it's not needed always and at the same levels for all applications. And the fact is that more explainability also means less performance. So there's a trade-off. So you do have to keep that in mind. I think the third concern I would mention is also on the slide here, cybersecurity and data privacy. And that's just, a function of AI working based on a vast amount of data, which means there can be unauthorized disclosures, leaks, hacking, and again, that can be quite drastic in the financial markets. Imagine someone, a malicious actor that hacks a system that's used for high frequency trading. The fourth one I would mention, and that one I didn't see on the questions here or the answers here, is outsourcing concentration and systemic risks. I don't think I saw systemic risk. I think that's the one that concerns me the most right now. And so that's a function of AI being provided and data being provided and aggregated by a small group of players. So, you could say that big tech is becoming big AI. And that means that a lot of firms are relying on the same models, on the same data. That means that their behavior is now correlated, which may lead then to systemic risks, flash crashes, instability, all kinds of negative repercussions. So again, I think that's the one that I would say, is maybe below the radar, but it's a big concern for me.
Thank you, Martin. I actually want to build that off on that one. So let's try to deconstruct that for a second here. So systemic risk, model risk, correlation risk, what are we talking about here? Okay, if there's only one or two players in the space, and these are the engines that are driving all of the advice, and we're integrating AI-based algorithmic advice, robo-advisors into the advice ecosystem, what happens when all the advice is generating to the same type of trade, the same type of buying decision, the same type of selling decision? What does that mean for price signals? What does that mean for market efficiency? How can that exacerbate volatility in sell-offs? How can that catalyze investor herds? Those are some things that the systemic risk scholars are starting to think about. Do any of you have any thoughts? Are there built-in mitigants against that? Or is it just heading towards this herd formation and that's the inevitable outcome when we integrate AI-based advice? Or what type of mitigants are being built into that, if any?
Yeah, I think from what we've seen, at least when you're talking about the trading strategy side or the deployment of capital into the markets, I think, yes, there's a lot of similar models that are being used, but I think there's a pretty large variance in the intuition that any given firm has when they apply their data to the markets, which is a key part of how you actually build these strategies. It's not just throw AI at a data set and it's like instant profits, or I'd have a couple of islands at this point. And then the two is there are a lot of proprietary data sets that the largest firms will never have, that smaller firm, like that a lot of individual firms have, that comes out of their processes. So I still think that there's probably also another push towards seeing many different models and many different decisions being made within the market that will also create opportunities. That doesn't necessarily mean a concentration of systems.
Great, thank you, Chad. So I want to pick up on data, and I'm going to pose this question to Carole, actually. So as I mentioned before, data in creates the generation out. Generative output or descriptive output, analytical output, but it's the data in. And so let's take a minute to focus on this question of data. To quote one of the senior data scientists in the Advanced Research and Knowledge Management Division at the ASC, he likes to say, laundering biases through math, potentially. So if we have a biased data set, it can lead to biased outcomes on the generative effect. So let's talk about data here. So Carole, what considerations as regulators should we keep in mind? And I guess not just regulators, industry at large, anyone working in this space, what considerations should we keep in mind when determining what data sources to use for the AI systems that are deployed?
Yeah, so it's an excellent point that you're data set, the quality and comprehensiveness and relevance of your data set will impact what the output looks like. So the output is only as good as the data which goes in to feed the algorithm, and of course, the process by which the algorithm and the system is developed, okay? So you can have bias at both points. And then in the interaction with that output, you might, and with that system, you might bias it further. So we have to be mindful of where there are sources of bias and how we're mitigating that bias. But your question about how do we be mindful of data sources? Well, from a legal perspective, so I'm a lawyer by training, and from a legal perspective, we always look at what is the intended purpose of that use case. So if you step back for a minute and look at how law around artificial intelligence is being constructed, whether in Canada through the draft Artificial Intelligence and Data Act, which I suspect is going absolutely nowhere, but nevertheless, it is interesting to read. It is only 12 pages, so not very long. But if you also look at other jurisdictions, in the US, there are a number of different examples at the state level in particular, but also analyzing the two executive orders, one under President Trump, one under President Biden, to get a better sense of where there are trends in AI governance from a legal perspective, and then overlay that, just to overwhelm everybody in the room, take the EU Artificial Intelligence Act, which is passed, in force, and in the process of rolling out in its entirety, take that and overlay it on top so we get a good sense of what are the trends. And here's what we're seeing. Number one, the law is structured in a risk-based approach. And this matters when you think about data sources, because your entry point into your analysis and risk mitigation plan is around what is the use case. So am I using it in client services? Somebody had mentioned this earlier. Well, then you're going to be interfacing with individuals, and you're going to be much more mindful of your risk around that use case, as opposed to potentially document summarization, for instance, okay? Those might attract different levels of risk depending on the nature of your business. So we're always mindful of what is the intended purpose of that use case. What is the use case? And then what is the intended purpose of the AI system? And then you go to the data sources and you apply an appropriate analysis to quality, completeness, accessibility to that in the context of the use case and in the context of the intended purpose. And from there, we can then start to make informed decisions about what data sources we should be using and what data sources we should not be using. We can't do it in the absence. We can't start with that question. We actually have to start with, how are we intending to apply this system in what context? What is the nature of that system? And then, what are the risks associated with the use case? And then we can go to the data sources and say, okay, now we can make informed decisions about what data we should be using, what data we should not be using, and whether we can document the completeness of that. Just one last point is with privacy. So I would say privacy today, in today's day, privacy is a proxy regulator for AI. It is one of the areas, one of the levers that we see being used to regulate elements of AI. We've seen this with ChatGPT in the EU. We've seen it with Clearview AI in Canada, where privacy law, which is an established area of law, is being used to put guardrails and suggest a regulatory frame for artificial intelligence. So we also, when we're using personal information, of course, we have to be mindful of the question, do we even have the authority to use the data if it is personal information in the manner intended? And there are a lot of open questions right now as to whether the use of personal information to train algorithms is a secondary use subject to new consent, not to get into the weeds, but it's sort of interesting, I guess. Or is it a quality improvement issue such that maybe fresh consent would not be required? So just to show you the complexity of some of these questions, it's not just we've got a shiny new object in the room, it's we've got to be really thoughtful about how we're using it.
Thank you, Carole. So we're going to get into some specific use cases in a second here. I just want to mention, however, to the audience that you can pose questions. So there is a QR code at your table if you'd like to pose questions to the panel. If you put your email address in and we are unable to get to your question, a member of the advanced research team will reach out to you with an answer to your question, okay? So we'll ensure that we get to everyone's questions, but feel free to pose some questions, and we'll do that at the very end. So in Canada, we don't have pure algorithmic investment advice. We do not allow for purely deployed AI advice. We have human in the loop dynamic, where there has to be a human involvement in the deployment of an algorithmic or AI-based tool that augments the advice that a human would give. Now, some regulators globally are starting to allow. The Israeli Securities Authority, a couple weeks ago, greenlit a pure AI-based advice. And so these are things that we're starting to think about as regulators, is what is the role of human in the loop and human involvement? And so I want to pose a question to the panel. Let's actually ask Chad, and the other panelists too, feel free to provide thoughts. But Chad, are there certain use cases of AI in capital markets where direct human involvement is more important than others?
Yeah, definitely. And I think this might be somewhat controversial, at least within my industry. It would be that the default is not to replace humans. The default is not to push the human out of the loop. This type of technology is shown to be very, very powerful when its focus is on augmentation and pairing with a human instead of pushing the human out. So, it might seem that the AI guy wants to just replace everything. It's generally not the case. It's much more of an augmentation focus. But in terms of putting together a simple framework of how you can think of when a human in the loop should be in, when it shouldn't be in, it's more of a spectrum. It is the way that you should think of it. So, two things or two vectors to sort of think through on a human in the loop decision making on a model one is the performance of the model, and then two is the cost function around the model. So in terms of the performance, if you have an exceptionally good performing model, if it's better than human or as good of a human, okay, you can start having a conversation on maybe the human in the loop can be pushed towards, a supervisory role, less of them being in every single decision. But I think the key one is really around the cost function. And it's much more towards the negative side. So what happens when the model is wrong? In some situations, it's immaterial. If you tagged an email incorrectly, okay, it's not the end of the world. If Amazon gives you a recommendation for something that you're not going to buy, okay, not end of the world. If you're deploying capital into the market, and the difference, maybe a fat finger error, even in a model perspective, is like $10 million versus $100 million. That could be massive and catastrophic, both from your both from your profits, but also from headline or reputational risk with your clients. So that then pushes the conversation back to making sure that there's a human in a loop. So when you're thinking through any type of technology, it's what's the performance of the model, and then what is the cost of error that are a big thing. Then I think you start layering in some of the additional things that have been discussed, some data stuff as well, and just the regulatory side. So I think one to look at is the understanding of the model. So if the model is extremely complex, like it's a deep learning model, you have no idea why it's making decisions, okay, you need to start biasing back towards a human in the loop. If there's a governance model within your organization that doesn't allow you to remove the human, well, that's a very clear and easy decision. There are situations in which you almost have to push the human out of the loop, and that would be things like high frequency trading, where the model just breaks, or it adds no value if you have to have a human saying yes, that's okay with decisions. So there's a lot of different layers. One as well, last one would be around ethics, PII, biases. I think, again, you start pushing towards human in the loop. So deploying capital, you're probably always going to have a human in the loop. If you're doing things like credit scoring at scale, you might not necessarily have a human in the loop on every single decision that the model is being made, but you're going to have a very strong supervisory role. Why is it making decisions? How is it making decisions? How is it performing bias reviews? You're going to have a huge involvement. But I think the big point that I want to hit home for everybody is that this type of technology is really about augmentation. When you pair a human with these models, you tend to get very, very significant outperformance than either one of those two things in isolation.
Thank you. Yes, absolutely. Carole, go ahead.
I just want to add that when you take Chad's point about the governance model, that's really important in this context. just be mindful of the element of accountability, which we saw as a risk. Somebody had mentioned that as a risk, and how there is a shifting landscape of liability now associated with the use of more autonomous artificial intelligence agents. So we need to be mindful of that and bake that into our accountability structure. In addition, we have to be thoughtful about knowledge transfer. So a human in the loop, if they are not competent to receive that information, is not useful. So, and it won't ultimately serve the function that is intended. So being mindful of that knowledge transfer piece is really important, especially if those systems are not built in-house, but they are managed by a third party, and you're reliant on that third party for the output. You may not have the visibility of how the system is structured or how it's working, in which case that knowledge transfer piece becomes even more important.
How do you, I'm going to take up this accountability point, how do you navigate, as a regulator, the black box dynamic of this in ensuring that individuals are accountable, but also assessing how the tools are being deployed, what the data sets are, ensuring no biases? Is it possible to operate through a technologically agnostic regulatory structure, so a principle-based structure where we have guidelines, we have accountabilities, without the regulator having to be able to assess the black box technology? What are some thoughts on that, on the regulatory structure?
Yeah, sure. So it's a tough challenge to regulate something that we don't understand, but I think it's possible. So I think there can be a shift of focus to outcomes and to standards, to certifications, to outputs. So, take like credit scoring. We may not understand why the AI decided in the way that it did, but we can look at the outcome. Is it ethical? Is it compliant with the law? Does it make sense when you look at it from the perspective of a financial market sort of custom? And focusing on that can then help us overcome those issues, and we don't need to understand everything fully in order to regulate it effectively. Or we can rely on, it's called disclosures, right? Still would be very important in the financial market space. You can ask for disclosures on specific AI risks. You can ask for disclosures on what kind of AI and risk management policies do you have in place. We can ask even for third-party certification, so we can get stress testing, we can get third-party audits in. So, these are all things that are being looked at. The draft data, as Carole said, may or may not ever become a reality, but that already has or would have quite extensive obligations in those respects. What does someone need to do when you introduce, manage, operate an AI system? And it does that without trying to understand what exactly is going on inside the black box. I think it was interesting what was said about human in the loop. I think very sensible approach, but what Chad says, not always do you have to have a human in the loop, but that's not actually how the regulator currently sees it. So when you look at the draft ADA, it always says human oversight. Or when you look at the European Union's regulation, always says it's human-centric, human in the loop, human oversight. And that may or may not always work for all the applications, especially in financial markets, where you need speed, you need efficiency. It doesn't work, doesn't make sense. You're not that good at overseeing these kinds of systems.
So what you're saying effectively is, from the regulatory side, we have to be very surgical, we have to be very precise, we have to understand what use cases absolutely require a human in the loop, and what, if you have a human in the loop in other use cases, we might be impeding innovation and maybe impeding capital formation. Is that effectively
exactly
what you're saying?
Be just willing to accept the fact you won't always understand everything. It's not possible, but you can still regulate, but focus on other things, focus on the outcomes, focus on the standards, focus on disclosures.
Yeah.
Can I just
Yes,
add one point
absolutely.
to that? If you look at the structure of the law, it is fundamentally a due diligence framework. So the way it is trying to adapt, ADA was intended to be an agile regulation. And I'm not sure it fully achieved that, but that was its intention. And so the whole point of ADA was that you are giving guidance to what guardrails look like, so that you know what assessments and questions you need to answer or conduct in order to demonstrate your diligence. So just to Martin's point about explainability, what's really important in this respect is that if you are going to make a decision to use an entirely black box system, that you have documented it somewhere and you can justify it. Because right now, ADA is not in force. It has not passed. But it doesn't mean that you're not going to get questions. OSFI came out with its EDGE principles, EDGE being ethics, data, governance, and explainability.
Excellent. Okay, let's take up governance. So I'd like to hear from all the panelists. I'm going to direct it to Martin. Martin is a private equity chair in corporate governance. You publish extensively on it. You have a new piece on AI considerations in relation to governance. My question is kind of general on this. Should firms develop new governance frameworks in relation to AI systems, or can existing governance frameworks be adapted for this?
Yeah, sure. So I think I'm kind of in the middle, sort of a hybrid approach, if you will. So I think existing governance frameworks, they still work. They are robust, and they can be expanded to include AI. So just as a small example, the board already is usually tasked with approving major AI tech investments, and that can be easily expanded to artificial intelligence. So I think that's important, that all works, so you can keep that, you just need to expand it. But there are some unique, specific risks to AI, and so there are some tweaks needed. So they're not huge. There can be things like adding an AI ethics advisory committee, or having AI governance policies in your organization. I think that's very helpful. And that doesn't mean, that you have to reinvent the wheel or draft anything from scratch, because there are now these emerging standards and frameworks that you can use. So as one example, ISO came out a few months ago, I think, with ISO norm 42001, which is about managing AI. So I think that's a very helpful one as a starting point. Then we have these guidelines on using AI in a trustworthy way. The Ontario government, for example, uses that. Can also be used for the private sector. Then we have securities regulators that have released guidance on how to use AI in a responsible way in the capital markets, for example, the AMF. So that's helpful as well. And as we said a few times, ADA may or may not be coming out. And if that comes out, then it's not a matter of what would we like to do, should we do, but then you must do actually a lot of things. And I think the final piece is board education. So the board needs to understand AI, not in the sense of directors being technical experts, but enough so that they can challenge management, that they can ask the right questions. So to your question, I think it's a hybrid approach. It's great what we have now. We can build upon that with just some tweaks and additions.
Great. Any other thoughts on governance?
Yeah, I would say, from my perspective, I think it's a really important thing to have within the organization and actually invest in it, because one of the limiters that happens right now when you go and work with some organizations is that they don't have a governance model. They don't know how to work with AI, so it's just sort of kills any type of project, internal or from an external thing. So I think if you have that governance framework, you give this sort of team within your organization the ability to start pursuing this and taking advantage of it. So we see governance as sort of a removal of some of the barriers to actually adopting AI within an organization.
Yeah, I remember, Carole, at the very beginning, you said 72% of whatever, or CEOs aren't looking to engage. Is that partially because we don't have the governance framework? So it's something that's, they fear this and what it could mean, and if we had those pieces in place, that would lead to better adoption?
I think there's a part of that. So I absolutely agree with both panelists. I think you don't need something net new that is perfect and gold standard. And governance will accelerate innovation. It will give everyone the comfort that we have a plan and we know what we're doing. I take a hyper-practical approach to this when we support clients in this space. I always say, give me your blue sky use cases for the next 3 years. Then show me what your existing data governance, privacy, IT security, enterprise risk management looks like, because you probably have 80% that's already in place. All you need to do now is bridge the delta between your blue sky ideas and what you already have in place to account for those specific risks to do with AI. And usually it has to do with exactly what Martin said. There's a lack of sort of knowledge and understanding on how to assess an ethics use case or what it means to assess high risk. And there's often a lack of understanding at the executive and board level as to what those risks are, what the opportunities are, why there is a competitive advantage to proceed, and what are the processes in place that you can relatively easily institute to have much more robustness in your governance and due diligence practices.
Excellent. So we're getting some interesting audience questions, and I'm going to get to these shortly. The final question that I'm going to ask the panelists, and then we'll go to the audience questions. I want to come back to the advice. I mentioned the Israeli Securities Authority, greenlit pure algorithmic-based advice. So as regulators, the ASC, CSA, if we're assessing the question of advice, particular AI-based advice, what should we be thinking about? So directed to us as regulators, what should we be thinking about in terms of regulatory safeguards for AI-based advice? And any panelist can answer that.
I'm going to throw in one really quick one, which is harmonization. We are overwhelmed right now with, I think when I looked at this last, and this was a few years ago, there were something like 100 different frameworks out there purporting to give advice on how to do the right thing with AI. It's overwhelming. So I think in that respect, the point that I really drive home hard is we need harmonization and consistency in standards across the board for regulators giving advice out to market participants, for regulators using AI internally. There needs to be harmonization and consistency in approach, as long as it makes sense, obviously. But I think that's a key, a really important consideration for regulators in particular.
Thank you.
I think one other thing there as well, and I think Martin touched on it a little bit, is that it's hard to predict where the technology is going to go over time, but I think the one thing we can be confident in is that it's only going to get better and better and better over time, and it's going to start creeping into more areas of the market. So, I think that's one thing for regulators to figure out is, you're obviously balancing risks and innovation, but just understanding that the technology itself is just getting better and better and better. It's not linear like we saw, you go 5 years ago, there wasn't ChatGPT. Now there's large language models like ChatGPT and Cohere, and that was sort of just, this huge step forward with the technology. More and more of that is likely to come than unlikely, so regulators preparing for that.
Final thoughts on this, Martin?
Yeah, sure. I mean, in addition to everything that's been said, remain flexible, and as you do, communicate with the issuers. That's important. Work together with other regulators. If and when ADA comes, there are lots of obligations there. If you have an additional set of slightly different obligations that come from the security side, it will just be confusing and add to the workload for everybody. But stick to your guns. Disclosure. Disclosures that are AI specific. What kind of risk management systems do you have in place? What are your specific risks? Maybe think about things like third-party certification. So standards and outcomes, I think that should be the way to look at it going forward.
Great, thank you.